Hello and welcome to BST Live. Glad you could join us today, where we're going to be talking about the year 2020. Wow, what a year we have had. And we're going to be looking back on some of the events and trying to see if there's some things we can learn to be able to better deal with market uncertainty. So let's get started. Well, hello, good morning, good afternoon, good evening. Welcome to BST Live. We're going to be talking about the year 2020 and what we can learn from that to better deal with market uncertainty. So glad you could take the time to join us today. We've got a fantastic guest. Our guest today is Michael Grech. Now, Michael has been on the BST podcast before, back quite a few years ago when we were audio only, and now he's here to join us live where we can ask him some questions and stuff. So Michael is a quant trader. He has a background in DSP or signal processing and computer modeling. So welcome, Mike. Glad you could join us today.
Hi, Andrew. Thanks for having me.
Now, well, as I mentioned, we're going to be talking about 2020 and what a year it has been. I mean,
Indeed.
Wow, not just in the markets, right, but out of the markets. And, I know you've got some interesting insights to share with us and how we can apply and take some of those events in a practical way to better deal with market uncertainty. But first of all, how about we start with a little bit of your background just so that we can put this all into context. So can you share a little bit of your trading background, the styles and the markets that you like to use when you're trading?
I started trading in 2008 after the financial crash there. I think I had just started in 2001 when I first got my job after college, and 10 years had gone by in 2008, and I had not made much money. So I decided to try and take a more active role in managing my own portfolio, and I started buying stocks, like value stocks, and that was 2009. I read Buffett's book, and I kind of went with the whole value philosophy. And I used to pick stocks, and 2009, it was like one slam dunk after the other, right? Everything, you buy something, like I bought Air Canada, I bought oil companies, I bought drilling companies, I bought a payment processing company, and everything doubles up within a few months, right? But it was kind of very fortuitous, very lucky timing to be entering the market. And then I didn't like the uncertainty of what I was doing. I tend to be a risk-averse person. And so with my background in physics and mathematics, I decided to try and quantify my approach. And I started writing algorithms to try and quantify, come up with a systematic way of choosing stocks instead of feeling like I'm guessing all the time. And so over the years, since 2008, 11, and now up to now, I've moved pretty much 100% to a quantitative approach for all my investing. Yeah. And then in 2017, when we first had our first conversation, 4 years ago now, 2 years ago, just when I launched my website, Quantopolis, and I published my book trying to share some of my ideas and make some of my strategies available for public investment. So, and then here we are today.
Yeah. So when we were chatting, I think earlier in the week, excuse me, about what we're going to talk about, and we were talking about what an anomalous year it has been, and it really has been, not just in the markets, outside of the markets as well. It's really been a crazy year. But if we just look at the market action we've seen, why do you think this year has been different to what we've seen in the past?
Well, it has been different. I remember before all this happened, I remember Jim Cramer saying that the only thing that's going to derail this market, given the amount of free cash around, or almost free cash, would be an exogenous event. And here we are with the COVID pandemic, and 12 months later, we have what some people have called, 5 years of market action in a year. And sure enough, if you look at the chart of the S&P 500 that we were looking at before, you see when the market crashed in 2008, it took about 5 years to 2013 to achieve new highs. Whereas in this year, it went down fast in a month and up again fast in a month. Maybe we can show the chart we
Yeah,
were
we've got
looking at?
we've got a slide for that. Let me just put that on the screen. So this
Okay, so
one.
yeah, so
Yep.
this is the 2008, 2013 situation. So you have about 5 years for the market to make new highs. And then if we move on to the next one, and there is 2020, just 1 year. So the question then becomes, how did this, strong movement within just a period of a year, how did it affect some strategies? And we can look at two different strategies. I mean, we'll talk a little bit about some other stuff, but if we move on to the next slide, I mean, typically there's two ways to invest or two ways to trade. One is a trend following or a momentum system, right? Like a buy and hold or things like that, or more active momentum strategies, or as value investing, where you try and find good price stocks and hold them whether for short term or long term. So let's look at those two approaches. And for the momentum strategies, you see this is one of my strategies actually that I just recently launched for my clients or my subscribers, and you can see that 2012 is about 120%. Sorry, 2020 is 120%, and this is just trading the S&P 500. So, and the average before that, over from 1993 to 2019, I mean that's a long period, is about 7.56%. And then this year, it's more than 10 times better.
Yep.
All right, and move on to the next one. And this is the Quantopolis, actually ES pullback strategy, which trades the S&P 500 using the futures, but this is just the S&P 500. And again, 2020 was a very good year, but not too much better than, let's say, other previous years when there was great volatility, like 2008 and other years like that. So I also have to add that with these strategies, I developed these strategies in 2017. So, sorry, 2016, and so 2017 onwards is out of sample, right? So you can see that, a lot of times when people talk about backtesting and investing and quantitative trading, we're always worried about the downside and of what could happen and risk management, which we'll talk about that. But this is a year where the opposite actually happened, where the strategy, you launch a strategy and your results for this year, 2020, are way, way better, more than 10 times better than what happened in the past. And particularly for momentum strategies, where you're trying to trend follow, I mean, these were ideal conditions because the market had a V-shape, like straight down pretty much, and then straight up since March or April, all the way to now. I just was checking the futures that just opened, and they're up again. So I wouldn't be surprised if this rally continues. I mean, sure, there may be bumps, but it's going on. So anyways, it's been quite an anomalous year. Yeah.
Yeah. So that's quite interesting to see those two charts, comparing them from 2008 and from this year. If you take out the time scale and the price, they almost look the same, right? So it's pretty incredible that we've squashed so much different market behavior or market actions into just 1 year.
Yeah, that's right. And I mean, if you look at maybe if you can pull up the chart again, I have a chart there that I took out 2020. And if you look at
is this one?
Forward, yes.
Forward, sorry. A few more.
Forward, yeah. Yeah, there we go. So this is the one you were just talking about. I mean, it's not that a momentum strategy did badly in the previous years. I mean, it still averaged 7.56%, but this year is literally off the chart. So, and that also had implications for the pullback strategies, because there were months where there was no signals. Like if you're trying to trade pullbacks in the S&P 500. There were months where there was no pullbacks, and that is not uncommon. I've seen that before, like 2 or 3 months in the past. But what's different this year is the magnitude. And when it comes down very sharp, and when it goes up very sharp. And that can act in both ways. Like, for example, recently in September, it took out a couple of my stops right away in the pullback strategies because it came down so hard. Because it's not gradual. And so everything is condensed into a little bit. And then you read, like for November, the S&P 500, I think, had the best November on history. and so did the Russell. I think 18 point something percent for the Russell in just 1 month. I think it was a record-setting month. The Russell has been trailing the S&P 500 for a while there, and now it's switched. The small caps are leading, and the other ones are lagging. So, but that wasn't like that for. I mean, the Nasdaq has been on a roll for years. So,
yeah. That comment you made, the comment you made about the pullback strategy not having as much opportunity as the past because there hasn't been a lot of pullbacks during that period is interesting, because I remember when we were discussing this off air, we were talking about the limitations of models, and there have been some events this year that really have been perhaps something we haven't seen before or for a long time. For example, I remember one of the events you mentioned was Trump delisting Chinese stocks.
right.
Can you talk a little bit more about that, the limitation of models, and how important it is to understand your strategy rules and how that's going to be impacted by what's happening in the markets?
I think you're hitting the nail on the head there. I think the most important thing is that you understand your strategy. Let me give you an example, which is what we were talking about last week. I trade for my own portfolio. I trade stocks, right? And I use a value strategy for the stocks. And I like to update the parameters on my strategies every year. And this year I was doing the regular updating after all this market thing had happened after March, after the crash. And I was getting really, really anomalous results, as if the strategy wasn't working anymore. And then it turns out that and I had traded the strategy live, so I knew it was work. But the 2020 skewed the results so much that you had to take them out if you're trying to build a strategy, And so I guess the important point that I'm trying to make, like you saw there in my backtesting, I used 1993 to 2016, and so you had the tech bust in 2001, you have the financial crisis in 2008, and you figure, okay, I've covered all the possible markets. You had areas of low volatility, you had areas of high volatility, you have bull markets, you have bear markets, and then 2020 comes, and there's something similar but yet different, And I think the most important thing is that no matter how big your backtesting history is, and in my case is I think bigger than most, going over 20 plus years, you are always only seeing part of the picture. You are never seeing the complete picture, and so everybody has to keep that in mind when you're developing strategies, when you're trading strategies. And this is, I guess, if you want to take one best point from conversation today, I mean, that would be it. That whenever you're doing backtesting of quantitative strategies, you have never ever seen the whole picture. And so things can be different. They can be different in your favor, and also they can be different against you, right? And so there comes the question of risk limitation, and how do you deal with that, which you mentioned earlier.
Yeah. So there's a question in the chat here, actually, which kind of links into that risk. Let me just put it up on the screen here. It's from Al. One moment, I'll just pop it up on the screen here. This is based on when you were just showing us the charts of the outsized performance this year. Al says, was there a similar increase in drawdown in your 2020 strategy performance as well?
Well, some strategies had a bigger drawdown, and some strategies had a smaller drawdown. Like as you see, the momentum, it was almost no drawdown at all. I mean, it was ideal circumstances. It was straight down and straight up. The pullback drawdown wasn't as bad as, let's say, 2018, where the market was very, very choppy. And I got repeated. This is pullbacks on the index, on the S&P 500, or the Russell. Some of my stock value strategies, they had a bigger drawdown, and so I was reading some of your previous podcasts, Andrew, and reading some other articles online, and I mean, one of the biggest questions is, how do you know when to put the plug on a strategy? How do you know when a strategy is not working? And there's different approaches, whether you do a equity curve filter, whether you do a stop loss, whether you do different things. I think the answer is you can't really have a one box, what's the word? A black and white approach in a way that one shoe fits all, because you really have to understand your strategy and what's going on, right? For example, you mentioned the Trump delisting the China stocks.
Yep.
Say I have a strategy that I developed for stocks over the last 20 years, and there was never such an event, right? So clearly, that's an event. If that happens, that's an event that's not going to show up in your backtesting, right? But something where other things, like if you're trading, for example, with stocks, you can trade foreign stocks like ADRs, such as Brazilian stocks or European stocks. Now, if the currency, which has happened, like the Argentinian currency crashes, then all your Argentinian stocks might take a hit. And if that never happened in your backtesting, then you wouldn't see it. It doesn't mean it cannot happen, or the Chinese delisting is not going to happen. So you need to know what are the limitations of your strategy and make your risk rules or your risk guidelines accordingly. And those rules are going to be different for different strategies depending on what the strategy is about and what's driving the strategy.
Yeah. So what if you've got a quant-based strategy where you don't understand the rationale behind it? Maybe it's based on not so much the examples you were giving there, but maybe it's statistical, or it's some kind of edge or anomaly that isn't easily explained. What do you do then? How do you know then when to pull the plug?
I tell you what I do. I don't trade it.
Right.
Because I have actually personally looked at those strategies, and I have traded some, and it was an expensive experiment, because then they don't pan out. And I like the strategies that I like to trade. I like to have a fundamental understanding of what's driving those strategies, and so that doesn't mean you can't make money with other stuff. And if you have a if I was to theorize here, if you have a statistical strategy like that, then maybe you can have a hard statistical drop. You can run the math and say, my odds of having, such and such loss are less than 5%. If that happens, I'm going to take it off. Now, you're never going to know why that happened, because, even if you read the book by Ben Mesrich, I think, the guys who beat Vegas. Remember that one? 21, I think was called. They made a movie about that.
Yeah.
There is an episode where the guys lost everything. And it happened that, one in 1,000 chance, or I don't know, despite their math, despite their edge, despite their advantage, you're going to have a losing streak, and you lose it all. And so you're not going to know with a statistical strategy whether that's the case, or whether there's something fundamentally changing with the markets you're trading, right? But to safeguard your capital, I think I would do an equity kind of filter and then wait and see what happens. If you have an equity filter and then, you stop, you safeguard your capital, and then if the strategy is still valid, it just statistically you hit that very odd chance, then you're safe. One thing we talked about last week, I've been reading the books by Nassim Nicholas Taleb, The Black Swan, and Fooled by Randomness, right? Yep. And so you always have that random chance and the random walk that can give you really good results, and the random walk that can give you really, really bad results. And there are statistical tests that you can run to try and see if this is just a random effect or this has statistical significance. So there is some math you can do to try and quantify that a little bit. In fact, I do use some math in my trading strategies with futures to manage my capital and try and have a 95 or 99% probability that my capital is enough.
Yeah. Okay.
So there are things you can do. Yeah.
Yeah, sure. Yeah, there's an interesting question in the chat, actually, which I'd like to pose to you from Chango. Let me just pop this one up on the screen. I think there's a lot of traders asking this question today. Here we go. If a global pandemic couldn't crash an all-time high overvalued stock market, in your opinion, what event can?
Well, I think based on past experience, I think the biggest trigger that's going to be, and this is what happened in 2018, I think, is the Fed raising interest rates. I mean, this market, from what I understand, is, and from like Ray Dalio was just saying a couple of days ago, I tend to post articles I like on my social media feeds, so people can find these articles there if they want them. I think this market is definitely driven by the cheap money there is, right? I mean, you can't really invest in interest-bearing stuff because interest rates are so low, and so people go in stocks. And I was just reading an article while I was waiting for this podcast. I mean, they were talking about this is looking very much like 1999, right? With all these valuations like Tesla, what is the word now? 20 times General Motors? I don't know, but it's on the news every day. You know, these hot flying stocks, it went up, I don't know, there are stocks that went up 300, I don't know how much percent this year. So I think interest rates is probably going to be the killer, you know. And one thing that we talked about Taleb and the black swans and stuff, he makes the point in his book that, you know, as black swan is something you can't really predict, you know. And so we tend to look backwards into like crisis, like the financial crisis or now the pandemic crisis. But the next black swan is not going to be something we can predict today, because otherwise it wouldn't be a black swan. I mean, a financial crisis, and the world today is not the same as it was in 1932, in the Great Depression. It's not the same as it was in 2008. And it's not going to be the same after the coronavirus now, too. And so, you know, I mean, going back to what we were talking before, like in terms of the momentum strategies having such an extraordinary year, I mean, some people say, oh, it's an anomaly, it's not going to happen again, but I'm not so sure. Why couldn't it happen again? I mean, the Feds are intervening more and more in the markets now. It's not 1932 anymore, it's not 2008. I wouldn't exclude that the next crisis, the Fed will intervene. I mean, it's a more sophisticated financial system today so that it was 50, 100 years ago. So who knows what's going to bring the next market crash.
Yeah. I want to dig in a little bit to a comment you made, I think it was more like a passing comment you made a couple of minutes ago. You're talking about the outsized returns of some of these strategies that are in the most recent year. And I don't remember the exact wording you used, so you know, you might have to correct me if I got it wrong. But it sounded like you were indicating that the recent performance could be skewing backtests and things in the future. So can you explain a little bit more about, you know, the impacts that the most recent year could have in the future for algorithmic and quant traders?
Yes, I think maybe you can pull up this the slide I have of Striker is jumping a little bit ahead, but we can definitely talk a little bit about it. Yeah. As I mentioned before, I have my strategies listed on Striker. Here they are, and Striker is just one example, but there's different brokers and all like Collective and others. Oh, when you have a group of systems of trading strategies, they always like to show the ones that are doing the best, right? And I like to call these the lucky ones. And I'll make a note here that my strategies are here, like Quantopolis Z and Long is number 3 there, and Quantopolis VX Short is number 3. And over the past 2 years, Quantopolis Z and Long was in the number 1 spot for pretty much 2 straight years. And all this is saying, I'm not saying there's anything wrong with this, but I'm saying that choosing a strategy based on this alone is not enough, right? The intelligent investor has to look beyond that. Like if we go back to what I showed before for my momentum strategy, the momentum strategy had 120% this year. Does it mean it's gonna make 120% next year or the year after or the following year? The answer is no, probably not, because this was an anomalous year. And this is what Kahneman talked about in his book, The Recency Bias. Like, when they develop prospect theory, is all based on these heuristics. And even though we think we are rational beings, we're making a lot of decisions based on our, what you call it, system one or intuition. You can call it whatever you want. And some of these decisions are not correct and not the right decisions to do. For example, a lot of people tend to invest in things that are doing really well recently, and that's part of what's called the availability bias, that the most recent information tends to have a bigger influence on you, on how you feel, and hence on your decision-making process, right? So one has to be careful and notice that. Like, it's interesting with Taleb, when you read his book, you see that even he wrote fooled by randomness. He acknowledges that he's also fooled by randomness. And so the key is, you can't help your emotions because this is how we are wired as human beings. So, but you need to recognize these emotions, and then you have to be rational beyond that and make decisions beyond that. And so system two has to take over system one in the words of Kahneman that we talked before.
Yeah, yeah. And what about the practical side of that then? I think at the start you mentioned that you like to reoptimize your strategies. I don't recall if you mentioned a period, maybe yearly or something like that. Now that we've had some of those strategies have had a really good year, you're going to be reoptimizing for that period. What do you think the impacts could be going forward by having that kind of reoptimization there?
Well, you can take two approaches. First of all, you can leave that period out, right? And then test it and see how the strategy does in the other years. But on the other hand, that period did actually happen, right? So it was real. It wasn't, it wasn't theoretical or anything like that. So what you can do is it's important not to just look at the results over that year, but you need to look at the results over every other year. Like, if every other year was a losing year or was a mediocre year, but this year was good, then it's not a good strategy. But if the other years were decent, like 7%, and then this year was a bonanza, then let the bonanza reign.
Yeah, okay. That sounds fair enough. Just looking in the chat here, we've got a couple of questions I think it might be good to pose now before we move on to another topic. So here's one from Gav. G'day, Gav. Glad you could join us today. Gav says or asks, since Michael is trading multiple strategies all the time, did he ever try adjusting money managed by each strategy based on recent performance?
The answer is yes, and I do that monthly, and I didn't always do it. And I have some strategies that are significantly better than others. And so they tend to accumulate capital faster. So say, for example, I allocate 10% to my future strategies, or 2% or 5%, whatever. And futures, just by their nature, they're leveraged instruments. So after a year, you could have easily done 50% return, or sometimes even 100% return. And so instead of having a 5% allocation in that strategy, you now have 10%. And so if the strategy was to hit a rough patch, then all of a sudden your portfolio is going to have more volatility. So I actually now physically reallocate capital every month on a monthly basis between strategies. Yeah.
Yeah. Why monthly? How did you come up with that? Is there something backed by that, or is it just
because I run my numbers monthly, and so I mean, you can do it less often. I mean, sometimes I don't do it if I check it every month, but if I think oh, it's okay, not too much from my mean or for my allocation I want to be, then I leave it. But if it's getting too high out there, and I typically see, like, this applies for any compounding strategy, really. Like, when you're compounding, right? When you're at the peak and you hit a drawdown, you're gonna lose the most money just because you're at the peak. So in a way, you benefit from when you're at the top. You take some money off so that when the pullback comes, which it is gonna come, you have put some money aside, right? So yeah, and ideally, you can also say the converse. When you're really at the bottom, if you really believe in the strategy, like whether it's buy and hold or anything, you should allocate a bit more capital, so that when the rally comes, then you can benefit from the rally. It's like trying to buy at the bottom. But it tends to be contrary to what people do, right? Because people like to do something that's working well, and this kind of human nature. Like if you are hanging out with somebody or you're doing something that's fun and pleasant for you, right? You want to keep on doing it. But if it's something that is not working for you, you don't want to keep on doing it. But trading, at least mean reversion strategies or the whole mean reversion concept, which Kahneman talks about too, is the opposite, right? If something is not working, but you believe it works in the long term, you should put more effort in it. Yeah.
Yeah, but I guess with the speed of the dips and recoveries these days, potentially could even get quicker in the future. Do you think a 1 month period might need to be adjusted to be faster, or is there you're not worried about that?
No, but I think it's like we said earlier. I think it depends what strategies you are trading. I mean, my strategies, I'm not doing any intraday stuff. So my strategies are all daily strategies. I mean, they have period from anything from 3 days to months sometimes. So for me, a month is enough. Now, if you're trading different strategies that maybe have a shorter time frame and have, you have to make different decisions. But for me, a month is enough.
Yeah. Okay. I've got another question here in the chat. This one is from Ola. G'day, Ola. Thanks for joining us. There we go, up on the screen. Any comment on if slower strategies are more vulnerable to dips like the one in March?
Slower. I'm not sure what she means. I have to think a little bit about slower strategies. I don't know. I mean, I guess by all measures, my strategies would be termed slower. Like I would call my momentum strategy a slow strategy. I mean, it's slower than the pullback because the average holding period for my momentum strategy is about 30 days at least. For the pullback is about 3 days. So the momentum did very well in March. So the answer, at least from my experience, from my strategies, the answer is no. Yeah.
So Ola just,
and I think
sorry, I was just going to say Ola just specified like weekly time frame strategies as what he means by slower.
I don't, I mean, possibly, I have actually tested weekly strategies, and in some cases I found a better edge. In other cases I found a smaller edge. So I think it all depends on what you're trading. I can see that if you're trading a weekly strategy on an index, it would have gone down harder, possibly, yes. But also going back to Taleb's book, I mean, he has a chart there talking about the time frames, and he makes the point that the smaller the time frame, the more you're seeing noise, and the larger the time frame, the more you're seeing signals. So I think longer time frame strategies are more likely to pick up fundamental signals in in the market, and so I tend to lean towards those than more active shorter time frame strategies. So there's that concept to keep in mind too.
Yeah. Okay. All right. Thanks, Mike. Now I just want to switch gears a little bit, change the topic slightly. To micros or futures and the advent of micros, which are kind of new. I've got here written in my notes the 2080 solution. Can you explain what you mean by that? What is the 2080 solution?
I think it's 2080. I mean, I mentioned 2080 because a lot of people have heard about the 2080, right? That some like 20% of what you do affects 80% of your productivity or outcome. It's a known concept out there, 2080 in different arenas of life. And it's not necessarily 2080, but it could be 595 or 3%, 97%. I guess in terms of, there's two applications, and maybe you can bring up this slide that I have about tail risk hedging there. And one other thing that came out this year, there were some articles out there that there were some people, you think, 120% is good. There were some people who did, 3,000% and things like that. And this is when these markets happen like this and volatility shoots up to the roof. Things like tail risk hedging and things like that have a really good impact. So a 3%, for example, investment into out of the money options in as a tail risk hedge can have a really big impact on your portfolio in these circumstances. The other thing with futures, again, futures have leverage. Now, let me say something about that. A lot of people are afraid to trade futures because of leverage, right? Because first of all, leverage. A lot of people use leverage. Every time you have a mortgage, you're essentially using leverage, because if you spend, let's say, $20,000 deposit to buy a $200,000 house, then it's a 10 times leverage. And if the house depreciates by 10%, then you've lost your $20,000. And it happened in the past in some, like in Canada right now, our houses have gone down because of the economy and the pandemic and things like that. So there are people who are losing money selling their houses. So people are familiar, leverage is out there already. The second thing, when it comes to futures and leverage, you can control how much leverage you have in futures by the amount of capital you put in. So, for example, I can't remember what the S&P 500 was, it 3,500 now, or the Nasdaq is 12,000. Okay, let's take the Nasdaq. Let's say it's 12,000, and to buy one contract of the Nasdaq is let's say $5,000, and it's a multiplied by 5. So if it's 12,000, you're essentially buying $60,000 worth of the Nasdaq. So you can either take $60,000 in cash and buy the QQQ, and how many shares that might be, or else you can take $5,000 and buy one contract of the Nasdaq futures, the micro futures. And so if you buy 5,000, you still have an exposure of $60,000, right? As if you bought stocks of $60,000 worth of stocks. So you can manage that leverage by allocating as much capital as you want. Instead of 5,000, you can use 20,000 to buy one contract, and then you have reduced your leverage to a third. So things like that. But to 2020, what was new in 2020 was the introduction of the micro contract in futures. So whereas before you had to buy one mini contract, which is 50 times the index in the case of the S&P 500, and all 20 times the Nasdaq, right? Which is a lot of money for a lot of people. Now the micro contracts are affordable for most people. So you can buy one micro contract, which is only 5 times, or as 2 times the Nasdaq. So you can buy it with as little as $2,500. You can trade futures, very accessible to people. So you have more opportunity there. And the whole idea about the 3%, 97% is that if you can boost your portfolio by 2% a year or just 5% a year, that makes a huge difference over your term cumulative value of your portfolio. So there's a new opportunity that came with 2020 with the introduction of micro futures.
Yeah. So that you're right. That does make it futures much more accessible to people. Do you think they're taking that opportunity up, or do you think people are holding back and waiting to see what happens?
No, I think they are definitely taking the opportunity up. But based on my own experience on Striker, I have a lot of clients, new clients trading my micro strategies, and so clients with smaller accounts and getting a feel for things, and in bottom, I think retired in the US, you might be able to do it with retired accounts too, not in Canada. And so, yes, I think a lot of people are taking opportunity of that. And the other option it also gives you is you can even scale much faster with futures now, because I think Berkshire Hathaway is around $2,500 for just one share. So now we're talking about it's comparable to a stock investment for like a future investment. So there is definitely more opportunities now, and I was talking about that because in his book about tail risk hedging, which I have in my slide over there, one of the options he talks about, one of the options to hedge your portfolio is using momentum strategies. Is the next slide there? Keep going down.
This one? No.
Like forward.
I'm going the wrong way, I think. Yeah. Hang on, let me go back.
Yeah.
Keep going. Not this one.
No, forward. Yes, forward.
There we go. I found it.
Tail risk hedging. How to profit from volatility during tail risk events. He has a chapter dedicated to momentum investing and more active quantitative strategies as a way to hedge your portfolio in times of volatility and just buy and hold. I mean, another thing we talked about is how the whole idea of um, the stock bond approach, where you have what 60% in stocks, 40% in bonds, might not be enough because it might not get you there. I think what we need to remember is that when people are investing money, they have some kind of goal in mind, whether it be retirement, whether it be saving for something. And to reach that goal, you need to have a certain amount of capital at the end of it. And to get to that capital, which I talk about in my book, is the biggest effect that has on that capital is not how much money you put in or how long you put the money in, but rather the rate of return that investment generates. And so if you can do anything at all possible to try and improve that rate of return, I think you should give it some serious consideration because it will make a big difference to your bottom line.
Yeah. Okay. Got a couple of questions here in the chat, which I might want to, which I'll raise. So this one, I think this one just popped up as you were talking about the stock bond mix. Let me put this one up. This is from RS. G'day, RS. Does it benefit to protect your long-term portfolio with a put option?
Yes, the straight answer to that is yes, for two reasons. First of all, if you're looking at a stocks and bond option situation, then you might be able to increase your stock allocation by purchasing put options, because you essentially have the same amount of risk, but you have better returns. So that's number one. And two is, if you look at that book on this slide, he actually has done some quantitative analysis of how you can actually generate some returns, like by having cutoffs at particular values of like, let's say 5%, 10%, 20%. When the put option multiplies, you take out the money, and it sort of pay for itself. So the definite answer is yes.
Okay, great. Thanks, Mike. Another question here from Gav. Gav's on fire today. He's got a lot of questions. Let me put this one up. Thanks for the question, Gav. Do you adjust your parameters or strategies for each stock, or is it the same for the broader market? And where do you draw a line between over-optimizing and under-optimizing?
Well, I have different strategies. I have strategies that trade stocks, and I have strategies that trade indexes, right? And so I think I was thinking a lot about, before I came on this show, about this whole thing. I think when you are doing backtesting, you are actually fitting a curve somewhat. Now, you don't want to overfit, but you're always fitting some kind of curve, because you're trying to come up with a model that fits the data, and you hope that that model gives you predictive power for the future. So you're coming up with backtesting is coming up with a model. So the simpler you keep the model, the less likely you're overfitting. So for example, if you have a set of data points that you put a straight line, it's one parameter, one straight line, and it can be simpler than that. Now, the more parameters you add, the likely it is that you are finding a very particular situation, and the future is not going to be like the past or the present. So when I have a strategy that trades the indices, it just trades the indices. Then I have strategies that trade stocks. I don't have different parameters for different stocks. I just have one strategy, and it trades a basket of stocks, and they all use the same strategy. So that's how I use it. Now, I don't know. I've never tried developing a strategy for, let's say, one stock, such as Apple or Tesla or something like that.
Okay. Here's a question from Al, which digs in a little bit deeper about how you build your strategies. Thanks, Al. How do you go about identifying your edges? It's more a strategy development question.
Well, it's very, very hard. Let me put it out there. I mean, 99% of the stuff I try doesn't work. It's not a fun thing. I mean, doing research is not a fun thing, and a lot of things are, are dead ends, really. So, I mean, I have two approaches. I have some momentum strategies. I have some value investing strategies. I've tried some statistical strategies, like you've mentioned in the past. And that's about it. I mean, those are the concepts, and then you can try different ways to try and get that objective, whether it's moving averages, whether using some indicator and some things. One thing that I always like to point out is that indicators are always simplification of the chart, if you will,
Yeah.
because you can't run an algorithm on the chart. Well, you can by using price action or bars or whatever it is, but indicators are always a simplification of the chart. So the indicator never ever ever has more information than the chart itself has, right? So I get a bit worried when I see, like, oh, I took the signal because it was above the moving average, or my MACD or whatever told me that. There's no the MACD is no magic wand. The MACD
Yeah.
is just an oversimplification that you're using to feed to the computer, that the computer can actually crunch some numbers. But there's nothing special about anything. There's nothing special about the MA, simple moving average, to 100, which everybody uses. There's nothing special about the 50. There's nothing special about anything. Now, sure, if everybody is looking at the 200 and everybody is reacting to it, then it might be a self-fulfilling prophecy. But
Yeah.
technically speaking, there is nothing special about those. And so, there's no magic there,
Yeah.
Yeah.
Yeah. That's well said. That's a good thing to keep in mind, that about indicators. So thanks for that, Mike. Now, I'm conscious that we kind of jumped all around in the slides, so I want to just jump back and make sure that we haven't missed anything that you wanted to share. But while I do that, I'm just interested to know, we've got quite a few people who are watching this live. I'm interested to know, because Mike, you've shared with us some interesting insights into 2020 and how you can use that to make ourselves better, and better to work with market uncertainty. I'm interested, what about people who are listening live? Have you had any observations or insights in 2020 that you'd like to share? If you just put them in the chat, and we might come back to them after in a moment. But Mike, so let me just put up the slides. I just want to make sure. I feel like we've forgotten something, and I don't want to miss something that you wanted to talk about. So let me just put the slides up here quickly, and I'm just going to go back, because I know I've been going the wrong direction as well. So just let me know.
Okay, yeah.
So
I think I just wanted to put these books out because, I mean, I still think we mentioned Thinking Fast and Slow 4 years ago when we first had a chat,
yeah.
and I keep reading books, whether it's Food by Randomness or Black Swan. I mean, everybody refers to Kahneman and his work. I mean, he clearly didn't win the Nobel Prize for nothing. I mean, even Nudge, which is another famous book, he quotes Kahneman. Well, the reason I put Nudge over there is because it has a very good summary of the heuristics, or these biases that we have in our thinking, that affect how we make choices in life and also in trading. So that's what I wanted to share about those books. Next.
Okay. I haven't read that Nudge book, so I'm going to add that to my reading list. It sounds very interesting. So heuristics, we did talk about this a little bit. Yep. Go on.
Right. These are the heuristics, and that are summarized very nicely in Nudge. By the way, I mean, going back to the previous slide, another interesting thing that Kahneman makes is they hired him once, some Wall Street firms, to try and quantify scientifically if stock pickers at these large firms actually had an advantage. And he found out, plain and simple, that they do not, and so, but clearly, if you say these people, essentially these people are just being lucky, which is the same argument that Taleb does in his book, Fooled by Randomness. And if you go forward, I'll come back to that in a minute. If you go forward and these are the heuristics, and I highlighted two here. One is the availability, is that we tend to remember what's most recent happens, and the other one is gains and losses. And I put the gains and losses up because my wife is a psychologist, and you always talk about the psychology of trading, and losses always seem to hurt more than gains. And they say whether it's in a relationship, in trading, or whatever, you need like a 5. It's not a 2-to-1 ratio. You don't want to win twice as much as you lose, but you want to win, ideally to feel good, you want to win 5 times as much as you lose, right? So 5-to-1. And so when you're dealing with strategies, if you're dealing with like a trend following momentum strategy, that's not going to happen, because in trend following, your ratio is a good ratio of it's 40-45%. In terms of pullback strategy, your ratios are 65 to 70%, but then your losses are big, right? In momentum strategies, you win less often, but your winners are bigger. Whereas in pullback strategies, you lose less often, but your losses are bigger. And so this makes it hard psychologically to stay in strategies when you experience losses. But so this is important to keep the heuristics in mind, as to say, okay, no, I know why I'm feeling this way, and I understand that this is part of the process. It's not a sprint, it's a marathon, and I need to stay with it, provided that you truly believe in the strategy. So that was the point I wanted to make about that. And then moving on. Okay, and Food by Randomness and the Black Swan, these are both Taleb's book. And one thing that Taleb makes very, very clearly is, is the information that we don't see. Like when you see, whether it's on Striker, whether you see people who winner, we're all the time, we're surrounding, but whatever has survived, essentially, the whole survival theory, right? What we don't know is the businesses that have failed, the strategies that have failed, the ideas that have failed, or the actors that didn't make it. And we think, okay, and we tend to, the human mind wants to try and build a narrative. Oh, he's successful because he's very talented. He's successful because he's very capable. And there are a lot of capable people who have not succeeded. There are a lot of talented people who have succeeded. And we tend to forget the element of luck that it plays in life, that it plays in trading. This is very interesting. Like this year, I launched 2 strategies, the momentum one and then another modification to my pullback. And the same month, I launched both of them. One of them had a loss and one of them had a win. And they're both equally good strategies, but it's just luck. You can't just say, oh, I should have done this, I should have that. You can't do that, because that's just pure luck. And so these ideas are very well discussed in these books. So that's why I put them over there. All right, next. And this we've talked about this before. And this is, I mean, a little bit of protection for the black swan, which we've touched this earlier. You can't really have a one size fits all. But I think the main point I wanted to make, that the best risk management tool you can possibly have is capital allocation. So like they say, don't invest monies that you're not willing to lose, right? So that is the ultimate control there is. Sure, there is tail risk hedging, there is diversification, but the ultimate control is capital allocation. Next.
Yeah, we covered that one.
We talked about this one, and these are the micro futures. I wanted to put them up. It's actually from the broker I use, and you can see like over here, like for example, and they also have them for volatility. Like instead of requiring for almost 40,000, 30,750, now you only need $1,375 to start trading volatility. So it's very, very, very affordable now to be able to take advantage of some of these more alternative strategies to diversify your portfolio.
Yeah. And that's the end of it. Okay, great. All right. Well, thank you very much for that, Mike. So I think we'll just start wrapping up now. So if anyone's got some final questions, please post them in the chat before we go. So thanks for sharing everything you did today, Mike. Where can people get more, learn more from you, or get in touch with you?
If they just visit my website, and if they have any questions, I'll be happy to answer them or have a conversation. They can email me anytime or call me. I have clients call me all the time. It's not a problem.
Yeah. Okay. All right. Well, thank you very much. I mean, 2020, as we've discussed, has been a very interesting year. I think it's always good to try and learn from these kind of things and look at the positive. And I think you've really shared with us a lot of good ideas and ways to think about, what's happened, how can we strengthen our trading, and what can we learn from this and approach market uncertainty in a better manner going forward. So I really think, thanks for sharing that. Is there any final comments you'd like to make before we finish up?
No, I thank you for having me. I think the most important thing, like I said, is make sure you understand the strategy that you're trading and have a full understanding of it. Yeah.
Yeah. Okay. Great. All right. Well, I think we'll finish up for now. So thank you, Mike, again for joining us, and everyone who came along live today. We really appreciate your comments and your questions. And now this is the last BST Live for the year, actually. So I'm going to be taking a break for the next couple of weeks, but we do have something I'm going to share with you next week, which is trading related. It's pre-recorded, but it's different to everything I've shared before. So there will be something next week, but I just want to thank everyone for the support this year, and thank you for your support today too, Mike. It's been a really good year for that, and we look forward to seeing everyone in the new year. So take a break, have some rest, enjoy your Christmas, New Year's with your family, and thanks again. We've just got some thanks here in the chat. I might just share these before we go. So here we go. We've got a thanks from Gav. Cheers, Gav. Thank you. We've got one from Chengo. Oh, they're coming pretty quick now. I think I'm going to miss a few. Ola said, thank you. Sko. Here we go, Sko. Thank you very much. Nice discussion as usual. Happy holidays to all the BST folks. Yeah. I've missed a couple. Sorry. Here's one more from Jones just to say thanks and bye. So thanks again, everybody. And thanks again, Mike, and all the best for the new year. All right. Cheers. Bye-bye.